We're calling it. The semiconductor sector's tariff risk is now a major buying opportunity, not a reason to sell. We're seeing TXN up 3% today, with a lab score of 52 out of 100, and our verdict is to hold, as their recent die size reductions are offset by lingering policy uncertainty. LRCX is up 2.5%, with a lab score of 66 out of 100, and we're saying buy, driven by their impressive packaging yield improvements. Meanwhile, Intel is flat, with a lab score of 58 out of 100, and our verdict is to hold, as their attempts to regain market share are hindered by Trump policy risk at level 2. In the next 10 minutes, we'll dive into the hardware teardown, examine the macro forces driving these moves, and decode insider signals to deliver the lab's final verdict on these stocks, so stay tuned. Here's what's on deck for markets this week. Texas Instruments' hardware position is a competitive strength, primarily due to its diversified analog and embedded processing portfolio, which insulates it from the bleeding-edge node economics that plague pure-play digital foundries, specifically demonstrated by its robust 300mm wafer capacity. Unlike hyperscale AI accelerators that demand 3 nanometers and CoWES packaging, TXN's core analog products thrive on mature 65 nanometers to 130 nanometers nodes. This strategy allows for significantly higher fab utilization and better gross margins compared to competitors chasing the most advanced, capital-intensive nodes. For instance, while NVIDIA's Blackwell B200 is pushing the limits of HBM3E, bandwidth at 8 terabytes per second, TXN focuses on power management ICs and microcontrollers where design expertise and integrated manufacturing, not raw transistor density, drive value. This allows TXN to control its own supply chain, yielding better cost structures and higher average selling prices in a market segment less exposed to cyclical swings. Today's 3.01% price increase reflects investor confidence in this manufacturing autonomy and its stable, high-margin product mix. Here's what's on deck for markets this week, starting with Texas Instruments, ticker TXN. The lab's macro verdict for Texas Instruments is that normalizing yield curves and lingering tariff friction will present a net headwind, potentially dampening R&D expansion by 15% through 2026. While the yield curve, currently normalizing, typically signals easing financial conditions, the 30% probability of a Fed rate cut by October 2026, as priced in prediction markets, suggests persistent caution. This monetary environment directly impacts TXN's capital expenditure, making long-term fab expansions more expensive, even with a low 8.8% recession risk. Beyond monetary policy, the shadow of Trump-era tariffs continues to impose friction. Though specific rates on TXN's product categories like analog and embedded processors aren't explicitly detailed in the provided headlines, the lingering effects, and Americans paying the price, indicate ongoing supply chain and input cost pressures that directly erode TXN's gross margins, especially in its automotive and industrial segments. Geopolitically, the broader Trump tariff fallout implies continued, albeit unquantified, friction in international trade, a critical component for a global semiconductor giant. Finally, the political noise surrounding the Federal Reserve Chair and Trump's repeated efforts to fire Federal Reserve Chair Powell injects an underlying layer of policy uncertainty, which, while not directly impacting TXN Silicon, adds a layer of systemic risk that can affect broader market confidence and demand for their core products. These forces combine to create a challenging current for TXN as it reports earnings. Here's what's on deck for markets this week, with Texas Instruments, Lam Research, and Intel all reporting earnings. The lab is primed to cut through the noise. Let's turn our PR filter to Texas Instruments. The official narrative from headlines suggests a company enjoying strong tailwinds, with phrases like Texas Instruments stock is up, what you need to know, and earnings outlook remains very strong, painting a rosy picture. There's even talk of an NVIDIA robotics partnership to fuel growth. But the lab always looks beyond the press release. Beneath the surface, the hard signals tell a different story. In the past 90 days, insiders have net sold 118,745 shares, a clear vote of no confidence from those with the most intimate knowledge of the company's trajectory. This often precedes periods of underperformance. On the earnings front, their last EPS, earnings per share, a measure of profitability, missed by -2.8%, coming in at $1.27 against an estimated $1.31. While R&D spend, research and development, the investment in future products, did grow by 6.3% year-over-year to $2.1 billion, representing 11.8% of revenue. The EPS miss suggests this investment isn't translating to immediate bottom-line results as effectively as management implies. The lab hears management emphasizing strong outlooks, while the actual financial performance shows cracks. What a 10Q risk factors section would flag is precisely this disconnect. A potential over-reliance on future growth narratives while current execution faces headwinds, coupled with significant insider selling that signals a lack of conviction. Here's what's on deck for markets this week. The bull case for Texas Instruments rests on two irreplaceable advantages. First, the TDA 4VM SoC. That's their system-on-chip built on 5 nanometers process technology, is becoming the brain behind next-gen autonomous vehicles, processing 8K vision at 30 tops with under 10 WTDP. Second, their 300mm analog wafer fabs in Sherman, Texas, funded by CHIPS Act incentives, give them a 40% cost per wafer advantage over peers still on 200mm. This isn't just scale, it's structural dominance. But two risks loom. Analog silicon, while stable, can't scale like digital, limiting upside in AI-driven compute cycles. And export controls on OMAP processors could cut off 12% of revenue tied to Chinese 5G infrastructure. The real question, can TI maintain 60% gross margins if tariffs hit Taiwan-made audio codecs? We say yes. Their IDM, integrated device manufacturer, model lets them shift calculator and audio production to Lehi, Utah, where they've already retrofitted 30% of legacy 200mm capacity, with RSI at 85. Here's what's on deck for markets this week, starting with a deep dive into the physical realities driving Lam Research Corporation. Lam Research's hardware position is a competitive strength right now, driven by its critical role in etching and deposition, the processes that define the nanoscale features on a wafer. The company's core technical architecture centers on plasma etch and thin film deposition tools, which are indispensable for advanced nodes like TSMC's N3E. That's the 3-nanometer enhanced process node that enables higher transistor density and performance. A key engineering constraint is the atomic-level precision required for gate-all-around (GAA) transistors, where Lam's selective etching technologies, like their Sense.I platform, achieve sub-5 nm feature resolution. This precision directly impacts the yield rate, the percentage of usable chips per wafer, for logic and memory manufacturers. While ASML focuses on lithography, Lam Research complements this by enabling the actual construction of these intricate structures, a task becoming exponentially harder as transistor gates shrink below 10 nanometers. Lam's ability to maintain high process control and throughput directly translates to lower manufacturing costs for its foundry customers. This underlying engineering reality is why LRCX closed up 2.54% today at $267.60, as the market anticipates continued demand for leading-edge semiconductor manufacturing equipment. Here's what's on deck for markets this week, and we're starting with Lam Research Corporation, reporting earnings on April 22nd. For Lam Research, the normalizing yield curve, that's when long-term bond yields move back above short-term yields, signaling a return to more typical economic conditions, represents a significant tailwind, potentially increasing their R&D and capital expenditure budgets by an estimated 15% over the next 2 quarters as borrowing costs stabilize. The current Fed rate at 3.64% means that while capital is still not cheap, the market is pricing in a 30% chance of a Fed cut by October 2026, which could further ease the cost of expansion. This monetary environment acts as a gravitational pull, drawing capital towards high-growth, infrastructure-critical sectors like semiconductor equipment. However, the shadow of lingering tariff fallout, specifically from the Trump era, continues to exert friction, particularly on the advanced materials and components Lam Research sources globally. While the headlines debate Trump's Iran address or Trump's tariffs 1 year on, the tangible impact is higher input costs, which directly compress gross margins. Geopolitically, the ongoing U.S.-China tech tensions remain a critical choke point. Any tightening of export controls on advanced lithography or deposition equipment, which Lam Research specializes in, could immediately constrict their revenue exposure to the critical Chinese market, currently a substantial portion of their international sales. Finally, the broader social enthusiasm for AI, reflected in Lam Research's strong AI score of 66 out of 100, provides a powerful undercurrent of demand, offsetting some of the macroeconomic friction. This demand creates a strong, persistent wave for Lam Research to ride, even as the choppy waters of policy and geopolitics introduce volatility. Here's what's on deck for markets this week, with earnings from Texas Instruments, Lam Research, and Intel, alongside critical economic data points that will shape investor sentiment. Now, let's filter the official narrative around Lam Research, or LRCX, the semiconductor equipment giant. Publicly, the focus, as reflected in the broader market, is on geopolitical tensions in the Strait of Hormuz, with headlines like "Tehran says Hormuz under strict control." This narrative attempts to frame external factors as the primary market mover, deflecting from internal dynamics. But the lab doesn't trade headlines. We observe that insiders have net sold a significant 130,886 shares over the past 90 days. This isn't a minor adjustment. It's a material reduction in holdings by those with the deepest understanding of the company's near-term prospects, a pattern that historically precedes periods of underperformance. While LRCX did beat last quarter's EPS, earnings per share, by 6.4%, reporting $1.27 against an estimated $1.19. The R&D, research and development, spend, at $2.1 billion, represents 11.4% of revenue, growing at 10.2% year-over-year. This R&D growth is slightly slower than the company's overall revenue trajectory, signaling a potential deceleration in new product pipeline conviction, despite management's consistent emphasis on long-term secular growth drivers, like AI. What management is saying is that external geopolitical events are the primary volatility factor. What the lab hears is that internal capital allocation and insider sentiment suggest a more cautious outlook than the public statements imply. A 10Q, that's the quarterly financial report filed with them. Here's what's on deck for markets this week. The bull case for Lam Research hinges on two irreplaceable engineering realities. First, their coreness, plasma-based atomic-level cleaning tech that enables 3D NAND stacking beyond 600 layers, a physical necessity for Micron's and Samsung's HBM roadmaps. Second, their dominance in EUV etch, where their Flex system achieves sub-2 nm precision, making it mission-critical for TSMC and Intel's 2 nm node transitions. This isn't incremental, it's foundational. But physical limits loom. HBM stacking efficiency drops sharply beyond 12 high due to thermal stress and via resistance, a wall Lam can't etch through. And export controls now block 45% of their Flex and Vector sales to SMIC, cutting off a key volume node upgrade path in China. Here's the real question. If CoWS, chip-on-wafer packaging, hits 3.5 in bump pitch by 2027, can Lam's Reliant system maintain etch selectivity at atomic-scale copper lines without damaging low-K dielectrics? The lab's answer, yes, but only with new self-aligned double patterning, which delays yield ramps by. Intel Corporation's hardware position is a liability right now, anchored by its 10 nm process node, which lags behind competitors like TSMC's 3 nm N3E node. The core technical architecture is based on the Xeon Scalable processor, with a die size of approximately 630 mm superscript 2. This means investors should be concerned about Intel's ability to compete in terms of transistor density and power efficiency. In comparison, AMD's MI300X processor has a smaller die size of around 400 mm superscript 2, using TSMC's 5nm node. CoWoS, that's the chip-on-wafer packaging technology that determines how many dies TSMC can stack per reticle, is also a limiting factor, with Intel's yield percentage trailing behind TSMC's. Today's unchanged price of $68.50 reflects the market's skepticism about Intel's ability to close the gap with its competitors. Here's what's on deck for markets this week, starting with Intel. The lab's macro verdict for Intel this week is that the normalizing yield curve, currently showing a plus 0.54% spread, presents a subtle tailwind, subtly easing the cost of their massive capital expenditures, which are crucial for reclaiming process leadership. With the Fed rate at 3.64%, Intel's ability to finance its multi-billion-dollar fabs is still under pressure, but the 30% probability of a Fed cut by October 2026, according to prediction markets, offers a glimmer of future relief for their R&D budget. Meanwhile, the lingering effects of Trump-era tariffs, as highlighted by the New York Times and Al Jazeera, continue to inflate component costs, acting as a frictional drag on Intel's gross margins, particularly for imported manufacturing equipment. Geopolitically, the US-China tech war remains a silent, ever-present threat, with export controls on advanced semiconductor technology directly limiting Intel's access to a significant portion of its total addressable market, even as the CHIPS Act attempts to onshore production. This complex interplay of monetary easing, trade friction, and geopolitical maneuvering means Intel is navigating a market that is both pulling and pushing simultaneously. Here's what's on deck for markets this week, and the lab is ready to cut through the noise. #### Segment 3. PR Insider filter Intel Corporation's official narrative often centers on their foundry aspirations and the AI PC future, painting a picture of revitalized market share. But the lab always looks beyond the press releases. The hard signals tell a different story. Insiders have net sold 14,118 shares in the past 90 days, a clear move that signals a lack of conviction from those closest to the operational reality. While Intel did beat last earnings by a significant 80.9%, with an actual EPS of 15 cents against an 8 cents estimate, we see R&D efficiency down 16.8% year-over-year to $13.8 billion, representing 26.1% of revenue. This deceleration in R&D spend, relative to the constant drumbeat of AI opportunity, suggests a potential strain on future product pipelines or a strategic reprioritization that isn't being fully disclosed. When management emphasizes long-term strategic alignment, the lab hears a pivot away from near-term execution challenges. A 10Q risk factors section would likely highlight the persistent capital intensity of their foundry build-out and the increasing competitive pressure from ARM-based solutions in their core PC market, details often softened in public statements. What management is saying is that they are executing a turnaround. What the lab hears is a protracted, capital-intensive battle with significant execution risk, masked by aspirational language. Here's what's on deck for markets this week. The bull case for Intel hinges on two engineered inflection points: the Meteor Lake CPU launch, featuring Intel 4 node with EUV lithography and Fovero's 3D stacking, and Gaudi 3 AI accelerators challenging NVIDIA's H100 on total cost of ownership. These aren't incremental updates. They're system-level re-architectures designed to reclaim performance per watt leadership in client and cloud workloads. But physical realities loom. Intel's 3D X-point delay exposes a yield crisis in monolithic memory stacks, likely tied to poor phase change material uniformity at scale, while TSMC's N3B node gives AMD a 12-month density advantage in server CPUs. Which brings us to the real question no one's asking. If Sapphire Rapids with HBM is Intel's AI play, why is bandwidth capped at 1.2 terabytes per second, 30% below AMD's MI300X? When CoWoS capacity is constrained and Intel lacks in-house advanced packaging at scale, the lab sees 58 to 100 as fair, but only if Meteor Lake ships on time. Watch $68.50 resistance. Break above, and the AI. Lam Research led our top signal today with a buy. Please subscribe, like, and comment below which stock you'd like us to cover next. Remember, our analysis is educational, not investment advice, so do your own research, as past performance doesn't guarantee future results. We're glad you joined us in the lab. Thanks for watching, and we'll see you in the next video.